Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And yes, laugh. Let's have some fun along the way. Hi, I'm Michael Bull, your host to the world of commercial real estate. Thanks for being with us today. The focus of our show today is the single-tenant net lease industry. Well, let's meet our industry experts for today's show. First of all, let's meet Virginia Wright. Virginia is Vice President with the National Retail Group at Bull Realty. Virginia has earned the prestigious CCIM designation and was a top 5 producer at Bull Realty in 2010. Congratulations, Virginia. Virginia works with buyers and sellers throughout the United States to meet their real estate investment objectives in the single-tenant net lease industry, sharing insights and relationships to achieve results. Virginia, welcome to the show.
Thank you.
Also, please welcome Randy Gold. Randy is a CPA. He is Principal and Chief Operating Officer with AGH, an accounting and business advisory firm. Randy has an extensive background representing real estate developers and investors through purchase-sale transactions, deal structuring, consulting, and reporting. AGH professionals aren't just great accountants and advisors. They're skilled business partners and listeners who are committed to helping you achieve your goals. Randy, welcome to the show.
Thanks for having me, Michael.
Both of you have great taglines there. I feel like we're about to start the Super Bowl, you know. Also, please welcome Brad Thomas to the show. Brad is a net lease developer, an advisor. He has over 23 years of experience in the single-tenant net lease industry. Over the years, Mr. Thomas has provided nationwide real estate construction, development, and capital market solutions for build-to-suit, reverse build-to-suit, redevelopment, and sale-leaseback clients. Mr. Thomas has completed over 400 new stores, representing over 75 name-brand retailers and restaurants. Brad, thanks for joining us.
Thank you. Glad to be here.
All right, well, let's get right to the meat of the subject. Let's start the discussion with a quick look at why single-tenant net lease properties are popular. You know, what are the benefits? Why do some investors prefer net lease properties over other asset types? Virginia?
Michael, that's easy. These types of investments are often referred to as mailbox money, or another acronym that I've heard investors use is SWAN, S-W-A-N, for sleep well at night. They're nice. They're nice. You know, they have little or zero landlord responsibilities. They're generally with high credit tenants, long leases. So investors know they can be anywhere in the world and enjoy that nice mailbox money coming in every month.
You make it sound so easy. Okay, Randy. Randy, what are you seeing?
Well, you know, what we see is tenants who just love the ease of managing the projects. You know, a lot of our institutional-sized clients love the product because it's an easy one to go after and win. But, you know, in today's world, the ease of being able to manage a single-tenant net lease project is terrific for folks.
Yeah, you just go to the mailbox and get the check, right?
That's right.
Okay. Brad, what do you see? Why do people prefer net lease properties sometimes over other properties?
Well, I think from a tenant perspective, they prefer the billboard, the exposure, and also the convenience. Mm-hmm. From an investor, for a lender perspective, as Virginia mentioned, the acronym SWAN, sleep well at night, just the safe asset class, and I think that's the main reason that investors and lenders prefer that asset class.
Well, it makes sense. And, well, we've heard about the average sales volume and cap rates around the nation from Chris Mackey with CoStar. Well, of course, cap rates and activity vary in different markets and with different tenant credit. What are you seeing in your areas and types of tenant-occupied properties you work with mainly? Let's start with transaction volume. You know, what are you seeing now in 2011, and how does that compare to, say, the last 3 years, Virginia?
Well, I specialize in single-tenant net lease properties, so I'm seeing pretty steady flow of consistent sales, and I really think a lot of that is due to the favorable lending that we're seeing in this cycle where some of the other products and sectors are more challenged with financing.
So the multi-tenant business has definitely slowed down, especially last year, and started picking, or 2009 and started picking up in 2010. But from what you're seeing, the single-tenant net lease business just remained pretty steady.
Yes, absolutely.
And Randy, what have you seen in the markets you're working in?
Well, you know, over the past couple of years, our due diligence practice did absolutely no work because there was no such thing as acquisitions. They just didn't exist. Yeah. And over the past few months, we've gotten lots of calls from our clients wanting us to start some due diligence projects, and many of those are in single-tenant net lease space.
Well, that's glad to hear. And Brad, what are your experiences?
Well, I think supply and demand, and I think over the last few years we haven't seen a whole lot of supply. A lot of the retailers have slowed down, if not completely stopped their development practices. So we're seeing a lot of the retailers now falling back out and starting to expand and creating some of that supply. I think the capital is definitely available now, and there's a lot of demand out that in that space right now.
Randy, what are you seeing with your clients?
We're finding a lot of our clients chasing industrial deals. As the economy starts to turn around and supply chains come back strong, the industrial product is one that I think will be a very good investment, and many of our folks are looking at that.
Yeah, I think that's a great idea. I know we've got a lot of demand for industrial buyers as well, looking for long-term lease industrial properties. Well, let's look at something else that's coming down the pike here. For corporate transparency reasons, the Financial Accounting Standards Board is making changes that will require tenants' leases to be included on their balance sheet as a liability. Randy, tell our listeners the quick explanation of FASB 13.
Well, I've heard it described as the accountant stimulus package. I'm not really sure that we accountants like that moniker, but what we expect to see in the next few years is a change to the way leases are accounted for. Landlords will be required to put an asset on their books for the lease itself, and tenants will be required to put a liability on their books for those payments. So the transparency aspect means that these leases that are currently off balance sheet, you don't see the liability related to the lease on the tenant's balance sheet. Now you'll see it. It'll have a huge impact on tenants who all of a sudden have major liabilities on their balance sheet they didn't have before.
Okay. And what is the timing for the final ruling of how this is going to go down, and when will companies have to adhere to the new accounting methods?
Well, the Financial Accounting Standards Board and the International Accounting Standards Board are converging to have one global set of accounting standards as the business world becomes more global. We expect that this lease issue will become commonplace in 2013. I wouldn't be surprised if it goes out a little bit further, but for corporate and privately held owners that report GAAP financial statements, they may have to report 3 years financial statements as of 2013. So we could be looking at 2011, 12, and 13 where they're going to have these requirements.
And will we know the final outcome of this this year or this summer?
We expect that we'll have a little bit more information come June. There's a sort of a deadline that's been set by the standards boards, but I wouldn't be surprised if it gets put off a little bit longer than that.
So it's not a question of it happens or not. It's just it's going to happen.
I think it's going to happen. It's going to significantly affect the industry. Real estate professionals need to be aware of it, and consumers really need to be aware of it, because I think it's going to affect the way we look at companies that we might invest in. If we're looking at publicly traded single-tenant net lease investments, now all of a sudden there's these huge liabilities that we didn't take into account before. It's going to affect the investment market.
Well, it's an interesting subject, and as we were just talking off air, we've got an entire show that's going to be dedicated to FASB 13 and look at it from a lender's perspective, of borrowers, of buyers, investors, and see what it's going to do to the marketplace. Well, guys, we've been talking about FASB 13, and people are probably curious of how that might adjust the marketplace a little bit. How might the changes in FASB 13 adjust tenants' leasing decisions? And might the balance sheet hit cause them to prefer shorter leases? Randy, what do you think?
Yeah, I think there's a significant chance that we're going to see tenants who want shorter leases because of the liability that's going to be on their balance sheet. The flip side of that is you have landlords that want long-term leases in single-tenant net lease properties, and we're going to see an offset between how much TI they're willing to put into a deal when they're getting lower lease terms, shorter lease terms.
So from an accounting standpoint alone, they might want a shorter lease, but from a business standpoint, maybe stay with what they have. Brad, what are you seeing?
Well, I think that retailers will always continue to lease property to small investors as well as big investors. The retailers understand that the efficiencies in the business model, and they understand that a dollar that goes into an auto parts store is more efficient operating an auto parts store than owning the real estate. So I think the retailers will continue to see the efficiencies of leasing real estate.
Virginia, what do you think?
I've talked to some landlords that have presented to their tenants options. For instance, if you sign a 5-year lease, this is what your rent will be. If you do a 10-year, your rent will go down slightly, and if a 15-year, your rent will even go down more significantly. So that right there may be some incentives in giving tenants options to get those longer leases.
Yeah, it comes down to a business decision.
So I see that there will be a give and take on the amount of lease term versus the amount of TI and what the tenants are willing to put on their balance sheet. I think depending on the tenant, though, we may see some tenants who prefer to actually purchase the property. They're going to have to put a loan on their balance sheet the same way they'd have to put the lease obligation on their balance sheet. So from a financial statement standpoint, it's going to look about the same. It's going to come down to the economics. But we may see more of these tenants buying property on their own.
Well, let's talk about that. You know, if they buy, there's some negatives to that and positives. What do you guys think? You think some of these tenants prefer to buy in some cases, Virginia?
Yeah, I'm sure that there are. And again, it all makes sense on the bottom line of the profits. But in the cases of many of the tenants I'm working with, their profit margins are significantly higher in their sales than what they could obtain through owning the real estate. So, you know, I just don't know. I mean, it can go either way depending on who the tenant is.
And Brad, what do you think?
I think there's just a cycle. Look at Dillard's, for example. They're proposing to form their own REIT. They own a lot of real estate. Now they're looking at maximizing their real estate value to create some equities within the Dillard's company proposed to be a REIT. So I think everything will come in cycles, and this event I think will be a non-event, except for more of an accounting change, as just mentioned.
Well, so Brad, what you're saying, Brad, Virginia, it sounds like is, you know, if they were getting, say, a 20% return opening more stores, and the real estate's going to give them a 10 or 12% return, they're going to open more stores.
Absolutely.
So in some cases, you think it's really not going to be that much of a change.
Absolutely.
I think it'll be interesting to see how the investment markets for some of these tenants react to the significant liabilities that will now show up on their balance sheet. You're talking about a national tenant will end up with billions of dollars of liabilities on their balance sheet that they didn't have before. And how will the stock market react to that?
Yeah, that's interesting. Stock market and then also the lenders with their loan covenants. And, you know, I've heard some lenders say, well, look, we've known they've had those off-balance leases and liabilities. You know, we've known about those. They just haven't been on the balance sheet. So it'll be interesting. Well, let's finish this up with a crystal ball question for you guys. Is this a good time to buy net lease properties? Are trends indicating that it's a good time, Randy?
Yeah, you know, I think it's always a good time to buy real estate, even in the economy that we just came through. If you had cash to spend, real estate was a good investment. And I think that depending on the tenant, depending on the location, I mean, it comes back to the fundamentals of real estate. All of our clients are looking at those fundamentals day in and day out. You find a good product with a credit tenant in the right location, and I think it's going to be a great buy for folks.
Virginia, good time to buy?
Absolutely. It is definitely a good time to buy. Today we're seeing slight compression in the cap rate, so now is the time to buy. So as the values increase, you're on the winning side.
Brad, quick point.
Absolutely. Single tenant should be part of every investor's portfolio, whether it's one property or in a co-ownership fund, non-traded REIT, publicly traded REIT, et cetera. So definitely bond replacement strategy is the way to go.
Great. Virginia, Randy, Brad, thanks so much for joining us today and sharing your insight.
Thanks, Michael.
If you'd like more information about the net lease investment industry, the contact information for everyone on the show is available at the show website, CREshow.com. Can you join us next Saturday at 10? Until then, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show on Biz 1190, always right on the money.